We are back for another Talk About It Tuesday, and I love these strategy questions. So let's get to it. Is it possible to use any retirement funds from a 403B to pay off student loans? The statement balance is currently around 800K, and the student loan is 45K. I still have 20 years to retirement. All right, so I love these strategy questions. So we have to look at a lot of different aspects of this before we can make a good decision. So first, let's make sure we understand what a 403B is and how it differs from a 401k, because a 403B is very similar to a 401k, which is a tax deferred retirement plan. And one of the major differences is that a 403B is usually for someone who works at a nonprofit organization or a government agency. So teachers, people who work for the government, whether it's local or on the federal level. Another major difference between a 403B and a 401k is that a 403B rarely, sometimes does, but rarely has a matching contribution from the employer. So everything else pretty much is the same. So is it possible to borrow from a 403B? Absolutely, but there are certain restrictions that are very important to understand. The government allows you to borrow the lesser of these two, either half the value of your total account or $50,000, whichever one is less. So you can't borrow more than $50,000 no matter how large your account grows to. But if you have less than $50,000, you can borrow up to half of it. And if you have $10,000 or less, you can borrow the entire amount. So the question is, can you borrow it? In this case, for a $45,000 debt, yes, you can borrow $50,000 from your retirement account because you have 20 years. But should you is the real question. So if you have 20 years to go and you did not contribute another dime to your account, we have to look at what the average return is for a 403B, and we'll look at the average return for a student loan. So average return on a 403B before fees is about 7% over the long term. After fees, because there's another difference between 401ks and 403Bs, the fee rate is a little bit higher. After fees, it nets about 5.5% over the long term. So if you did not contribute another dime to this account and you have $800,000 now, in 20 years when you are ready to retire, you'll have about $1.3 million in your account. So if you take $45,000 out, that over 20 years and would take away about $100,000 from that. But that's not the case, because the terms of a 403B loan requires that you return the full amount within 5 years of the date of the loan. So you only have 5 years to repay the $45,000 you borrowed from your account without a penalty. So you have 5 years to pay back $45,000, and it must be paid in equal increments, no more than quarterly, right? So you have to make at least quarterly payments over the next 5 years and pay it off. Here's the thing: you might be saying it's okay if I borrow from myself and I'm paying myself interest. This is true. However, the repayment cannot be with the pre-tax money. So with a 403B, your contribution comes from pre-taxed money and it gets taxed at the end like a 401k. The repayment cannot come from pre-tax money, which means it's been taxed, you took it out, and you have to pay it. Another tax issue is that the interest that you get from the already taxed money is immediately taxable, right? So that's not tax deferred. The interest you pay yourself on the loan is taxable. And at the end, it is part of the lump sum that gets taxed again. So you have tax issues. You have the fact that you're going to deplete yourself of some of the gain that you had at the end. Um, so it really becomes a math issue, right? And so if we look at the average student loan, the average undergrad loan is, I think, like 3.73% for the average undergrad student loan, and 5.28% for the average graduate student loan. So, assuming this person has a graduate student loan, because if they have 800,000 in a um, 403B, it means they probably already had a undergraduate degree and have been working for a long time. So assuming we're at the average, which is 5.28, if we look at the 5.5 that you would get from your account, you're still winning, right? And normally we pay down debt when debt hurts us more than the gain we get on our investment. In this case, the investment is paying more than the pain of the interest on the debt. And I don't know this person's specific numbers, but in the average case, the average gain is greater than the average pain. And so, and you have to pay that off in 5 years, where a normal student loan, they would have much more time. The question becomes, can you find an alternative way to pay, meaning a different loan other than borrowing from yourself at a lower interest rate than the 5.28 that you're paying on a student loan? Because if you can pay it off in 5 years, because you're assuming you have the income to pay it off in 5 years instead of the length of time you had before. If you could find a private loan at a lower interest rate than you're currently paying and pay it off in 5 years and not mess with the contributions that you have that would get you, 100 grand more over that same period of time, then that's an alternative. So there are a lot of factors. So you have to do the specific math, and a great way to do the math, if you go on calculator.net, you can look at an investment calculator and know exactly how much money you'll have in 20 years based on your contributions. If you do a debt calculator, you'll know exactly, if how many payments at what interest rate it'll take you to pay off the 45,000, whether you do 5 years or more. You can do a loan calculator. All these are free, by the way. And it will tell you what it would cost to pay back if you got a private loan at a different interest rate over a certain length of time. So it's really a math question. Is it possible for you to borrow from your 403B? Absolutely. But there are issues that you have to consider before making the decision to pull from there. So I can't say yes or no. You have to really go through the numbers. And again, with the tools that exist today, it's really easy. I know it sounds complex, but it's really not. To sit down, go through all the numbers and say, what makes the most sense, right? And if it was a case that was clear where the interest on the debt was greater than the return on the investment, it would be a no-brainer, right? It doesn't make sense, right? Because that's like having a bucket with a hole in the bottom. You don't invest when the pain of the debt is greater in terms of interest than what your return on investment. But in this case, you have a situation where the return is greater than the debt, and there are very strict guidelines for the loan. And you also have to figure out what the terms of the loan are from your administrator for the 403B, because perhaps it's much lower than the 5.28. If it's 2%, 3%, then it's probably worth it. So a lot of things to consider. Love the strategy questions. Hopefully I gave you some food for thought before you make your ultimate decision. Everybody like, share, comment, subscribe. Keep the questions coming, and I'll see you next Tuesday.